Welcome to Stock Market Palantir. In this video, we'll be breaking down another stock analysis. Be sure to subscribe and drop your opinion in the comments. Okay, let's hear from our analysts.
All right, let's just dive right in. We're looking at Kohl's Corporation, ticker KSS. And right now, the stock is just stuck, isn't it? It's churning in the low $20 range, which gives it a market cap of around, what, $2.3 billion? But that price, it feels like it's being held in place by this immense, unseen pressure.
It's a massive standoff. And that really brings us to the central question, the core of the debate today. What is actually driving the value of KSS equity at this very moment? Is it the deteriorating fundamentals of the business itself, or is it this bizarre, extreme technical situation created by the short sellers?
And that's exactly it. My position is that for the near term, what's happening is purely mechanical. This high short interest, this volatility trap, it completely outweighs the company's operational problems. The price is a function of market structure, not a reflection of the business's health.
And I see it the other way around. I think the volatility is just noise, temporary noise. The structural decline, the crisis in governance, the debt, the fact that they're losing in the retail space, that is the real anchor on the stock's value. We're basically looking at a tactical trade versus what I see as a terminal investment thesis.
Well, I get why the long-term story is frightening, but we have to look at the reality of today's market. This stock is not trading on cash flow. It's not trading on a discounted future profit stream. It's basically a derivative of its own market structure. I mean, you have almost 27.3 million shares sold short. That's nearly 25%, 1 in 4, of the tradable shares. That creates a mechanical risk for anyone betting against it. And that sheer volume translates into a really high days to cover ratio, somewhere between 6 and 10 days depending on volume. That is a technical pressure cooker. And we've seen this play out before. Just look back to July of 2025. The stock shot up 90% in a single day. That wasn't because of good news on Sephora sales. It was pure technical panic. Shorts scrambling for the exits. The price completely decoupled from any sense of valuation. And that dynamic, that structural imbalance, is what makes this a tactical opportunity.
That's a compelling point about the potential for violent moves. I'll give you that. But a tactical opportunity is not the same thing as long-term viability. I think focusing on that short squeeze potential is a really dangerous distraction from what's actually happening, which is the destruction of enterprise value. And the clearest signal of this rot is the company's credit profile. I mean, just look at the debt they had to take on. That $360 million issuance of senior secured notes due in 2030, it carries a punishing 10% coupon. 10%. That implies a credit spread of almost 600 basis points. It confirms what we all know. This is a junk-rated, non-investment grade company. The market is screaming about the risk here.
And more importantly, for anyone holding the stock, these are secured notes. The debt is collateralized by company assets. For the listener, what this means is that in any kind of distress scenario, any liquidation, the bondholders get paid first from those assets. The common shareholder is at the very back of the line, and there's likely going to be nothing left for them. That is the risk that should define this stock, not the day-to-day whims of technical traders. And that precarious financial situation didn't just happen in a vacuum. I think we have to start the core of this by looking at the governance instability, because that's what's driving that risk premium you're talking about.
Exactly. The termination of CEO Ashley Buchanan back in May of 25 for cause. That wasn't just a simple management change. It was a complete disaster. The investigation found this undisclosed conflict of interest with a vendor, a personal contact getting a multi-million-dollar deal. It just shattered market confidence. It suggested a catastrophic failure of internal controls, of board competence. You don't just move on from a scandal like that. It leaves a permanent stain.
I fully agree. That governance failure was catastrophic. I'm not defending it. It created huge volatility, exposed massive control issues. But I'm not convinced that a historical failure, even one that bad, is still the primary driver of the price action we're seeing today, months later. The market looks forward, and the board did correct the failure. They appointed Michael Bender as permanent CEO in November.
A safe choice.
He is a safe choice. He's the opposite of the last regime. He's a known quantity, a logistics operator, former COO of Walmart Global E-commerce. His entire strategy is explicitly shrink to survive. He's focused on operational excellence, constricting inventory, containing costs. And we see it in the numbers. Inventory is down 5%. This is about limiting that existential downside that the bears are betting on. It creates a floor, maybe an unexciting one, but a floor under the equity that makes a total collapse narrative much less credible.
But is limiting downside the goal here? That's just triage. It's hardly a bull case. And it doesn't solve the core problem, which is that Kohl's is stuck in what I'd call the retail muddy middle. They don't have the rock-bottom prices to compete with a TJX or a Ross, but they certainly don't have the prestige to compete with a Nordstrom. And the numbers prove it. A 1.7% drop in comparable sales in Q3 25. That shows the core concept isn't working. And that brings us to Sephora, this shop-in-shop idea. It's a paradox. The Sephora customer comes in, buys their beauty products, and walks right out. They don't engage with the higher margin Kohl's merchandise. So you've basically just become an expensive landlord for Sephora.
I agree. Managing decline is not a thesis for aggressive growth, but it is critical to prevent the insolvency scenario you're hinting at. Yes, net sales were down 2.8% year over year, but Bender's discipline is generating crucial efficiencies. Look at the gross margin. The tight inventory management led directly to a 51 basis point expansion in gross margin, up to 39.6%. This is about preserving liquidity to service that heavy 10% debt load you correctly flagged. They are managing their decline responsibly, and that prevents the kind of rapid collapse that would zero out the equity.
I'm sorry, but that 51 basis point gain is a footnote. It's a footnote against the fact that their Q3 net income was a meager $8 million. $8 million on $3.4 billion in sales. Do the math. That's a 0.2% net margin. They are operating on effectively zero net margin. There's no buffer. A single bad quarter, a supply chain issue, anything, and the company's posting a loss. The high short interest is a perfectly rational response to that fragility.
Which brings us back to the old real estate play thesis, right? The idea that the $2.3 billion market cap is less than the assets, that there should be a floor there.
And that thesis is highly, highly problematic because of the capital structure we already talked about. The argument that shareholders have a floor because of the real estate, it just completely ignores the debt. Those $360 million in senior secured notes give priority claim on the assets to the bondholders. You can't liquidate property to pay shareholders when secured creditors are first in line. The real estate thesis is a fantasy unless that debt is gone.
Okay, that's a strong legal point, and it's technically correct. But I would frame the market dynamic differently. The potential for asset monetization, even if it's structurally difficult, is still enough to keep the stock buoyant against those really low analyst targets, the $15, $16 range. The market has historically assigned a premium for this potential, for private equity interest, and that sentiment doesn't just vanish overnight, regardless of debt covenants. And look, management is trying to counteract the pressure. SG&A costs fell 2.1% in the third quarter. They are playing defense, and effective defense limits the downside.
But the rate of decline is still winning. SG&A fell 2.1%, but sales fell 2.8%. That negative operating leverage is actively destroying profit, not just managing decline. And while that real estate lore might persist, the institutional flows tell the real story. Vanguard is selling, analyst targets top out around $20. The big money recognizes that the technical trade is fleeting, and the underlying value is collapsing toward that secured debt line. You can't build a case on sentiment that the institutions are actively running away from.
This whole discussion really just hinges on two competing necessities, doesn't it? The case I'm making is compelling because the short interest creates a mechanical necessity to cover that can just override rationality for a time.
And my case is compelling because the deep financial fragility and strategic obsolescence create this inexorable force that eventually has to crush the equity value.
Right. So to summarize my view, the central narrative, for now, remains the extreme market structure. With almost 25% short interest and a history of violent squeezes, Kohl's is a high-stakes speculative play. The downside risk is being managed, or at least mitigated, by new conservative management. This makes the stock incredibly sensitive to any positive trigger, which keeps the potential for a quick run towards $25 or $30 very much alive. The technicals are the clock that's ticking the loudest.
And while I acknowledge that mechanical clock is ticking, it doesn't solve the fundamental crisis. That short interest is just a rational reflection of terminal problems. You have a zero net margin, a crippling 10% debt coupon that sucks up all the cash, and a business that is strategically irrelevant. For any long-term investor, the risk-reward is profoundly unfavorable. The institutional retreat confirms it. The stock's true trajectory is that of a debt-burdened, uninvestable zombie asset.
So the conflict, then, is whether the immediate, high-pressure mechanic of covering a massive short position can temporarily sustain a stock price that its deteriorating financial reality says should be significantly lower.
Exactly. And the real question for the market is, how long can that technical momentum overcome the gravitational pull of a 10% debt coupon and a collapsing business model? We'll be watching to see which force wins out.
If you enjoyed this video and want to watch more analysis like this, don't forget to subscribe to the Stock Market Palantir channel. Thanks for watching, and see you in the next video.